This is a special crossover episode of Payments Pros with the Consumer Finance Podcast. On this podcast, I'm joined by my colleagues, Chris Willis and Glen Trudel, to discuss the CFPB's final late fee rule. We hope you enjoy.
Welcome to this special crossover edition of the Consumer Finance Podcast and the Payments Pros Podcast. I'm Chris Willis, the co-leader of Troutman Pepper's Consumer Financial Services regulatory practice. And Josh McBeain, who's one of the co-hosts of Payments Pros, is joining me today to talk about the CFPB's final credit card late fee rule and the industry's reaction to it, which is breaking news that we really want to talk to you about. But before we jump into that topic, let me remind you to visit and subscribe to our blogs, TroutmanPepperFinancialServices.com and ConsumerFinancialServicesLawMonitor.com. And don't forget about our other podcasts. In addition to this podcast and Payments Pros, we also have the FCRA Focus, all about credit reporting. We have Unauthorized Access, which is our privacy and data security podcast. And we have the Crypto Exchange, about all things crypto. Those are available on all popular podcast platforms. And speaking of those platforms, if you like this podcast, let us know. Leave us a review on your podcast platform of choice and let us know how we're doing. And don't forget to check out our handy mobile app. It's a great way to access all of our thought leadership in one place. We've got all of our blogs, all of our alerts and advisories, and listening access to all of our podcasts all in the same mobile app. And it even has a handy calendar feature that shows you the conferences that we'll be attending and speaking at. So just download it. It's available for both iOS and Android. Just look for Troutman Pepper in your app store. Now, as I said, we're going to be talking today about the CFPB's final credit card late fee rule, which just came out at the beginning of March. Joining me, as I said, is Josh McBeain, who's the co-host of Troutman Pepper's Payments Pros podcast, and our partner, Glen Trudel, who does a lot of work in the credit card space. So Glen, Josh, thanks for being on the podcast today.
Glad to be here, Chris.
Yes, thank you. Glad to be here, Chris.
So Josh, let me start with you. Why don't you just bring the audience up to speed on what's happened? Tell them about the final credit card late fee rule and what it looks like.
Sure, happy to do so, Chris. So you can think about the final rule as changes for large issuers, which the CFPB has defined as card issuers that together with their affiliates have 1 million or more open credit card accounts, and small issuers. And there are changes that impact both. I'll start with the large issuers first. So to level set, under current Reg Z, there's a safe harbor for late fees for $30 for the first payment and $41 for subsequent payments. The CFPB's final rule lowers the safe harbor provision dollar amount for late fees to $8 for large credit card issuers. It also, which is important, eliminates the higher safe harbor dollar amount for subsequent violations for large credit card issuers. And finally, it ends the current automatic annual inflation adjustment, which currently takes place. For small credit card issuers, in the final rule, the safe harbor threshold amounts increased for inflation to $32 and $43 for each subsequent violation. So sort of a significant difference there. So for large credit card issuers, the safe harbor amount's going down to $8. And for small credit card issuers, it's increasing to $32 and $43 respectively.
And by the way, I thought it was very interesting because I think in the prepared statement from the director associated with the release of the final rule, the director made the comment that those automatic inflation adjustments were abusive or something like that. And I thought that was an interesting choice of words, particularly given what happened with the small issuers.
Well, one more thought on that, Chris, then. So in the final rule, the safe harbor threshold amounts were adjusted for inflation to $32 and $43. Small credit card issuers can charge $32 and $43 in the final rule. But large issuers may also do so for other penalty fees that are not late fees.
Interesting.
For example, exceeding the credit limit or return payment. So just to highlight your point, the CFPB didn't even apply the lower amount for all penalty fees. They only applied it to late fees for large issuers. And they're allowing even large issuers to charge the increased late fee amounts for other penalty fees.
Very interesting. I actually hadn't caught that nuance, so thanks for pointing it out. Glen, let me turn to you for a second. The final rule came out, I think, directionally in the way that we in the industry expected it to, but there are some important differences between the proposed rule and the final rule. Do you mind highlighting those for the audience?
Yeah, I can pick up a few. And to Josh's point, one of the things that was in the proposed rule was the concept that this might be extended to cover all penalty fees and not just, necessarily late fees. It was NSF or, over limit. That didn't happen in this rule. So they've made it a little more specific in that regard. Another is one of the ideas that they were going to have under the proposed rule was that not only would it be at the $8 safe harbor, but there would be this other rule to the effect that whatever you charge couldn't be more than 25% of the payment that is late, the minimum payment, if you will. That did not make it into the final rule either. Obviously, a very important thing for the banks and particularly for people who would have to, program that as part of their processing platform. Also, there was the exclusion of small card issuers. The final rule actually doesn't define large card issuer at all. It defines small as those who have less than 1 million open accounts in the preceding calendar year, which is interesting, but that once you cross that threshold, you are no longer a small card issuer after 60 days. So it would be somewhat difficult for perhaps an issuer who is marginally or approaching the $1 million threshold, or maybe is just over it, to avoid being a large card issuer because they need a clean preceding year of being under 1 million in order to do that. And if they're already over the line, it would be a long time, a good year or more, before they could adopt that standard.
Yeah, and Glenn, I want to add something to that that's interesting. And small card issuers need to pay attention to this definition. So if they go over, they have 60 days, as you mentioned, to then comply. But what's interesting is the way that they defined open credit card account. It's not only cards or plastic that are out that can obtain extensions of credit, it's any balance that's not been charged off. So if you have issued less than 1 million cards, but you have people significantly delinquent in your portfolio that have not been charged off, those count.
Oh, yeah. Oh, absolutely. It's not open to buy.
Yeah. So it's going to require diligent portfolio management on an ongoing basis.
Right. The banks that are sort of on the cusp will have to be making a judgment as to whether the loss of revenue that could follow becoming a large issuer is going to militate toward growing their portfolio if they're getting close. And it may be worth it to them. It may not be ultimately.
It's also interesting, the potential loss of access to credit too, right? Because if someone's got a card that they're keeping in their wallet for an emergency situation, maybe those are going to be closed by issuers now due to inactivity because people are going to manage their portfolio size. So it's interesting what the CFPB's done there, and it might actually deprive people access to credit.
And I think the point of depriving access to credit is also if you can't recover from those who are delinquent via late fees, then does that cause credit standards to tighten, credit limits to tighten, and affect access to credit that way too? The industry certainly has made that argument.
Well, what's interesting about that, Chris, is for large issuers, we've got this reduction to $8. But the CFPB said in the final rule that the rule does not change the credit card issuer's ability to raise interest rates, reduce credit lines, or take other actions to deter consumers from paying late. So the CFPB is kind of addressing that on that they think that it might increase the cost of credit. And they're telling large issuers that they can do that.
Yeah, and it seemed quite odd for the Bureau to say that after having just released a report complaining about how interest rates charged by large issuers are too high, because that just came out a few weeks ago, didn't it?
Yeah, it did.
And so I viewed that statement in the press release as trying to guard against or preview arguments against litigation that might arise concerning the final rule, which of course it did arise, and we'll talk about that in a second, because it seemed otherwise a fairly odd message and disconsonant with what it had said just in that report a few weeks ago.
Yeah. And I want to address something. So for large issuers, I talked about, we're currently at $30 and $41. There was a reduction to $8. But what I didn't address and what I'd like to get your guys' thoughts on is it's not just the $8 threshold. That's the new safe harbor. You can go over $8, but there's some burdens with that. I mean, what are your guys' thoughts on the final rule with being able to charge more than $8?
Yeah, I mean, I don't think that hasn't really changed in the sense that that was always an option. But since virtually no one does it, there's no precedent for it. And, while there are, some provisions under the reg, no one has taken that opportunity to make that analysis. Given the environment, that's probably smart. I don't see the CFPB cutting everyone to an $8 safe harbor and then being open about the possibility that, your costs are higher, so you can charge a higher rate. It also kind of ignores the fact that pursuant to the underlying truth in lending and so forth, these fees are supposed to be reasonable and proportional for the violation. And as in the case points out, that's a few elements. It includes taking consideration of deterrence as deterrence. And one of the arguments is that $8 is going to turn into a convenience fee, not a penalty fee. The conduct of the customer, as well as compensating issuers for all of the costs. And one of the arguments is that what they've done here is taken the deterrent effect out. They've basically limited it only to the cost aspect of it. And even then, not all of the cost.
And only the administrative cost, essentially, of dealing with the late payment, not the cost of delinquency, so to speak.
Right. Certainly after charge-off. I mean, that was an express change that they made. They said it was a clarification. It struck me more as whole cloth. But after you charge off, any collection fees don't count.
Yep. There's a bunch of commentary now, which you talked about, Glenn, that no one really uses, that exists today for doing this calculation that no one relies on because we have these safe harbor amounts. That still applies, and they added to that to specifically exclude those costs like you mentioned.
Right.
I'm with you, Glenn. I don't think anybody or not many people will avail themselves of the opportunity to, quote, show your math and charge a higher fee than the safe harbor, because honestly, I think you'd be asking for at least supervisory, if not enforcement trouble by doing that.
I agree.
Now, there was one other change in the final rule from the proposed rule that we probably should note. I remember the proposed rule having what I consider to be an especially problematic sort of grace period provision in it, and that vanished from the final rule, I think. Is that right?
That's correct.
So that's basically, it would have created a sort of federally mandated grace period for not imposing a late fee that I believed at least would be very confusing to consumers. And the CFPB fortunately dropped it out of the final rule.
That's right.
Yeah, it was. And that was confusing.
So, Glenn, you made reference to the case. So let's talk about the case. Because as promised by industry groups, they had basically said, hey, if this rule gets finalized, we're going to challenge it in court. And true to their word, just a few days after the final rule was released, there comes the court challenge. So do you mind, Josh, just telling the audience a little bit about who filed the challenge, where they filed it, and sort of what's the basis for it?
So it was a collective of trade groups, including the U.S. Chamber of Commerce, along with the Fort Worth Chamber of Commerce, the Longview Chamber of Commerce, and the American Bankers Association. The Communities Bankers Association and the Texas Association of Bankers collectively filed a complaint in the U.S. District Court for the Northern District of Texas, challenging the final rule. The trade groups argue that enacting the final rule, the CFPB violated the Appropriations Clause, exceeding its statutory authority, and offered deficient analysis and reasoning, all in order to achieve a preordained outcome that will ultimately harm those consumers the CFPB is charged with protecting. The trade groups further argue that the final rule's effective date violates the Truth in Lending Act. The complaint includes 5 counts, and I actually think Glenn already mentioned some of them, specifically relating to violating TILA, which is a really good point. So the Truth in Lending Act has provisions about safe harbors, and it says that safe harbors are penalty fees and are presumed to be reasonable and proportional to the omission or violation to which the fee or charge relates. That's what the Truth in Lending Act states. What's curious here is, and I think this is going to come out in litigation, how can $32 and $43 be reasonable and proportional for small card issuers and not large card issuers?
That's an excellent point. I was going to say that was a bright spot, I think, for its clarity, that if these are all supposed to be reasonable and proportional, how can it be that for large issuers, $8 is the number for safe harbor, whereas for small, you're looking at $32, and the difference only is how many open accounts the issuer happens to have.
That sounds like it could be arbitrary, Glenn. What do you think? Arbitrary?
Maybe even capricious.
Maybe.
Yeah, I don't know what makes 1 million the magic number, and I was reading specifically from the Truth in Lending Act there. So it's important to note that the CFPB has the ability to implement regulations and safe harbors, but it does seem pretty arbitrary how they've done that in this instance. And it's particularly interesting in light of the fact that they've applied the higher $32 and $43 amounts for all other penalty fees that large issuers can still charge.
Yeah, like over limit and return payments.
Yeah.
Right. With no analysis about that. This is only about the late fees, right?
In addition to just filing a complaint, the trade associations also filed a motion for a preliminary injunction, essentially asking the court, the Northern District of Texas, which is where this is filed, to preliminarily enjoin enforcement of the rule while the court considers the challenges. And since, of course, the Northern District of Texas is in the Fifth Circuit, which already has a controlling published opinion that the CFPB cannot engage in rulemaking because of its unconstitutional funding structure, one would expect a preliminary injunction to be granted in reasonably short order following the precedent of the Fifth Circuit's decision in the CFSA case, at least, of course, until the Supreme Court decides that case, which might be any time, but we don't know when it'll be. We only know it'll be before the end of June. So that was sort of the immediate industry response to the rulemaking. But let's go one step further. And I'd love to ask the two of you this question. Let's assume that down the road, the final rule actually survives. It survives both the CFSA decision and this challenge from the trade associations in the Northern District of Texas. What do you think the industry will do? And I mean the industry, both large and small issuers, in response to the final rule? Again, assuming it goes in as finalized at the beginning of March.
Yeah, I mean, Chris, I think there's, a number of things that we're going to see. I think they may take a page from what the CFPB said they could do and start looking at pricing, higher APRs, boosting fees, maybe creating new fees that maybe gets somewhat, gets to the same behavior, but isn't quite a late fee. That may be a possibility. I could obviously higher APRs is another possibility, and they might raise minimum payments, particularly for those they see have a greater propensity for late payments. Although that might be a little direct, but ultimately raising the minimum payment thresholds and tightening as part of tightening credit, you may see annual fees take an increase and maybe imposed for accounts that don't have them right now as a way of sort of recouping some of the revenue that they'd be losing from this. I could see less profitable accounts that have shown some propensity being closed. Again, tightening the credit risk and increasing their revenue per account. I could see more selectivity in their credit offerings in terms of sort of a flight to quality at the margins, so to speak. There's going to be a lot of more, maybe less directly. There are a lot of co-brand relationships out there, a lot of co-brand agreements out there. This drop in revenue, at least in the short term, will affect those relationships, particularly those where the co-brand partner has some sort of revenue share agreement with the bank. That can find its way into reduced rewards programs, less lucrative programs, that sort of thing. If there's less money to be had, then it stands to reason you have less to give away on rewards, right? So I think those are just some of the things we're going to see, in addition to the costs that they're going to have to deal with in the Herculean efforts of reprinting disclosures, changing terms to consumers, periodic statement reprogramming of their platforms, training of their employees. All of those sorts of things are all reactions, if you will, the things that they'll now have to do because the rule's in effect.
I agree with everything Glenn said. I mean, to sum it up, it's either going to be an increase the cost of credit for all consumers because it's going to be shared, and that's going to be done through higher APRs or fees elsewhere, or it's going to be the loss of access to credit.
Yeah, or some combination of the two.
Yeah, or some combination of the two. And there'll be significant implementation costs. I mean, Glenn mentioned changes to disclosures. I mean, the CFPB published, along with the final rule, a bunch of changes to model forms to address this. So any card issue that's got relying on the model forms or, obviously has late fees at the current safe harbor amounts, those require system updates and disclosure updates.
Well, we're obviously going to be continuing to watch what happens with this rule, particularly now that the litigation is in play. And of course, the members of the audience can check our blog anytime for the latest on it. And of course, watch your podcast feed because this is an important enough thing that we'll probably be podcasting about it again when significant events happen. In the meantime, though, Glenn, Josh, I'd like to thank you for doing this podcast with me. And of course, thanks to our listeners for tuning in to today's episode as well. Don't forget to visit and subscribe to our blogs, TroutmanPepperFinancialServices.com and ConsumerFinancialServicesLawMonitor.com. And while you're at it, why not go on over to Troutman.com and add yourself to our Consumer Financial Services email list. That way you'll get copies of the alerts that we send out, as well as invitations to our industry-only webinars. And as I said before, don't forget to check out our handy mobile app. It's available for both iOS and Android. Just look for Troutman Pepper in your app store and check it out. I think you'll enjoy it. And of course, stay tuned for a great new episode of this podcast every Thursday afternoon. Thank you all for listening.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.